Assalamu alaikum. Welcome to video 19. This is IAS 36 impairment of assets. So it is very unlikely in your financial reporting and also in your SPR that you will not be given a question where assets are not tested. It could be any kind of assets, tangible, intangible, financial assets, investment assets. So any type of assets. With asset comes impairment. Okay. So impairment is not separate. If asset is there, it will be impaired. So for that impairment, we are going to go through IAS 36 impairment of assets, how you deal with impairment. That makes this standard very important. And what I wanted to emphasize is that this standard is the most important standard after assets. So it will definitely be tested. Okay. Now, impairment is your expense. Okay. So impairment is measured by comparing the carrying amount of your asset or cash generating unit with its recoverable amount. If your carrying amount is more than the recoverable amount, your asset is impaired and you have to write it down to a recoverable amount. And if it's the other way around, when your recoverable amount is more than the carrying amount, asset is not impaired. But very rarely they will give you a question where the asset is not impaired. Most of the time, they always give you a situation where asset is impaired. So this is a picture. Compare carrying value with the recoverable amount, and recoverable amount is greater of fair value less cost to sell and value in use. Fair value less cost to sell. How will you get it? You will be given the selling price and the cost to sell it. Deduct the direct selling cost from the selling price. Next, value in use. This you have to estimate. Either they will give you the figure or you have to estimate. How? That is the present value of your future cash flow from the continued use of the asset. Okay. So this two things is basically what are you doing? One, fair value less cost to sell. You're finding out what is the value if I sell the asset. Value in use means what is the value if I do not sell the asset and keep using it. So you compare the two, whichever is higher is your recoverable amount. Whether it is better to sell the asset, amount is higher, or value in use is higher, and compare it with the carrying value. Now, there are indicators of impairment. Okay, and these indicators are divided into two categories, external and internal. Now, under impairment review, see, unless an impairment review is required by another standard, for example, IS 38 or IFRS 3, then your impairment review will only be required if there are indicators of impairment. But intangible asset and business combination, you always have to review for impairment. That's what they say, whether there are indicators of impairment or not. Other than these two standards, all the other standards require you to do the impairment review annually when there is an indicator of impairment. So now let us go through the impairment indicators. First, external, competitive actions, increasing interest rate, which can affect your value in use, because your value in use, you are using that interest rate to discount, right? Higher the interest rate, lower your value in use. Then market value of asset is falling. Change in the business of the market where assets are used, for example, government actions. What is the difference between internal and external indicator? External is something external, beyond your entity, outside your entity, not in your hands, not in your control. Now, internal indicators: physical damage to the asset, management committed to reorganize business, obsolete asset, ideal asset, major loss of key employees, operating loss in the business where the assets are used. Remember, these are inside the organization. But you can extend the life of the asset by repairing the asset frequently, by buying a new asset, by not keeping the asset idle, by retaining the key employees. You can somewhat have a little bit control over the internal indicators, but external indicators is beyond your control. Now, CGO, that is about asset. Sometimes it is not, you are not able to identify that this particular asset has been impaired when the asset is a part of a large group. So then you compare the cash generating unit where you pull all the assets, okay, that generates independent cash flows. So in this case, you have to find how are you going to do the impairment review. So, or not always possible to base the impairment review on individual assets, as an individual asset cannot generate distinguishable cash flow. In this case, the impairment calculations will be based on your CGO, where you will group all your assets together and then find out the carrying amount and the recoverable amount, compare them and find the impairment. So the impairment calculation is performed by comparing carrying amount of the CGU to the recoverable amount of the CGU. This is achieved by allocating the entity's asset including goodwill to CGU. Now, impairment loss are allocated to asset with the specific impairment first. Whichever specific asset has been impaired, first you will allocate the impairment loss against that. Then you will allocate in the following order. First against goodwill, second against other assets on a pro rata basis. Remember, assets can never be written down below the higher of fair value less cost to sell, value in use and zero. You cannot write down more than this. Now, how do you recognize impairment loss? Assets that are held at cost. If you are using a cost model, then your amount of impairment will go in your statement of profit and loss. Okay. If it's a revalued asset that has been impaired, then your impairment will first be charged to OCI to reverse any previous surplus on that asset in the same way as a downward revaluation. Then further impairment will be charged to profit and loss. Same way how a downward revaluation works. To know more about downward revaluation, you can watch out my IAS 16. Okay, in the same revision series, under the revision series itself, you have to go to IAS 16. There I've explained how downward revaluation works. First, against OCI, if you have to reverse any surplus, then balance from the statement of profit and loss. Now, example, your CGU has a carrying amount of 150, recoverable amount is 132. So clearly you know the difference is the loss because carrying amount is more. So there has been impairment loss of 18 million. Okay, these are the net assets. Goodwill 10 million, property 20 million, plant and equipment 45, and net monetary asset 15. There are asterisk marks next to property. Property has a market value of 25 million. So cost is 20, market value is 25. And your net monetary asset will be realized in full. This is the question. Now the solution. So the impairment loss of 18, you cannot set them against the property or the net monetary asset because these assets are not impaired. They told, right, net monetary asset has been realized fully. And also property value has been increased from 20 to 25. So those two assets are not. The remaining assets are goodwill and your other asset, that is goodwill and plant and equipment. So first you will allocate against goodwill. So goodwill amount is 10 million. So if you allocate against goodwill, so from 18, 10 million will go to goodwill. What is the impairment loss that is remaining? 8 million. So the remaining 8 million impairment loss you will set off against the plant and equipment, not fully, in proportion to their carrying amount. So thank you for watching and make sure that you do questions on IAS 36 from your revision kit, both for FR and SBR students. There are plenty of questions on IAS 36, which is a good way for you to know how IAS 36 could be tested. But IAS 36 is definitely tested. That's for sure. So thank you for watching and I shall see you in the next standard. Again, a very important standard and a very frequently tested standard, which is IAS 37. Provision, contingent asset and contingent liability. Thank you.